This video will explain how to account for the issuance of common stock. When a company records the issuance of common stock for cash, it increases or credits common stock for the par value of the shares. Amounts received in excess of par value are recorded in the account paid in capital in excess of par. Let's assume this company issues 1,000 shares of $1 par value common stock for $1 per share. The entry to record this transaction results in a debit to cash for $1,000 and a credit to the common stock account for the same amount. To determine the amount, you simply multiply the number of shares issued by the par value per share. Now, let's assume this company issues an additional 1,000 shares for $5 per share. The entry would result in a debit to cash for the amount received, and in this instance, it would be $5,000. We would credit common stock, but only for the par value, which is 1,000 shares at $1. The amounts received above the par value, in this case is $4,000, would be credited to paid in capital in excess of par value. Total paid in capital from these two transactions is $6,000. If this company has retained earnings of $20,000, the stockholders' equity section of the balance sheet would report $6,000 in paid in capital and $20,000 of retained earnings for a total of $26,000 in stockholders' equity. Some companies issue no par stock with the stated value. For accounting purposes, companies treat the stated value in the same way as the par value. If, in the previous example, the stock was no par stock with a stated value of $1, the entries would be the same as those for par value common stock, except the term par value would be replaced with stated value. If a company issues no par stock that does not have a stated value, it credits to the common stock account the full amount received. If this company issues 5,000 shares at $8 per share, the entry would result in a debit to cash for $40,000 and a credit to common stock for the same amount.